So yeah, thank you everybody for joining us. As Mark said, we're celebrating 10 years in crypto securities. Everyone's talking about securities tokens at the moment, and we've actually got a decade of experience behind that. So I'm just going to share some of the stories from the last 10 years so that we can set the frame for what we think the next 10 years looks like. And then we'll have some very different perspectives from some of the companies that made our industry. And I think we've got so much further to go as an industry. So that's me. And I said we're celebrating a decade in crypto securities. Here's some of our portfolio companies. We've now invested in 120 different companies in the industry. This is the equity rounds. Yeah, it's been an interesting journey. For those of you who don't know what Bank to the Future is, we're an online investment platform that allows accredited qualifying investors to invest in the equity of fintech and crypto companies. It all began really in 2010, and Bliss Dixon, who's the co-founder at the front here today, we wanted to build an investment bank. I was working in investment banking, left in 2006. Bliss Dixon was working in retail banking. I wrote a book called Bank to the Future. It actually, when it was published, became the first published book in the world to include Bitcoin. Because I was researching the topic of monetary reform. So before the Bitcoin community, there was something called the monetary reform community, and it was a bunch of people getting together discussing how fractional reserve banking was going to kill our economy. And we were looking at different things we could do. And in 2010, we set about opening a bank, and we wanted it to be non-fractional reserve. The idea was full reserve banking. The only challenge was there was no such concept as a challenger bank. That came yesterday. That came later. The regulators told us that we're going to need 60 million of capex, 30 million to build infrastructure, and we're both going to have to retire from the board and hire someone that's actually built a bank before. So it wasn't very attractive to us. So we pivoted to securities, and we set about changing the laws in the UK in order to allow for online investing and online venture capital and co-investing through a syndicate. The regulators in the UK at first, after a lot of resistance, about 3 years of lobbying, decided to change those laws. In the time that we were waiting, because we couldn't get up and running until the license had been secured, I got invited to speak at the first Bitcoin conference, and here it is in Prague. It was about a lot less people than are in this room. It was about 20 to 40 people. About 20 of them were just pure computer scientists, and the rest were die-hard activists that were out to try and eat the lunch at the banks. This is when I got my first Bitcoin. This week, the price of Bitcoin crashed from $30 to $3. It was sponsored by a company called Mt. Gox, who set us back about 5 years. And we heard a pitch from the first company we ended up investing in called BitPay, that was trying to create the PayPal. It was Tony Galippi pitching at the time at the event. And I met a gentleman called Max Kaiser that we later went on to create a fund that was the first fund investing in the crypto companies. In 2012, the US President Obama studied, or his team, probably not himself, was studying what we did in the UK, and they created the Jobs Act in 2012 and set about changing 80 years of securities laws based upon the success of what happened in the UK. And so it was a big trickle-on effect. 5 years later, it started to get liquidity through ICOs and as it met blockchain and various other things. But in 2013, we finally got added to the FCA register. The problem was, we wanted to support fintech and crypto companies. We'd done very well. Bitcoin was looking after us. We saw Bitcoin as the back-end infrastructure that meant we no longer need to build a full reserve bank. We were added to the register, but the license said you can only work with UK businesses and UK companies. There were no UK crypto businesses, and there were very few investors in the UK. It was a meet-up group of about 20 to 30 people that were meeting at a pub in Old Street. So in 2014, we set about trying to create a global model. So as I said, we met Max Kaiser at the first Bitcoin conference, and we decided to set up a fund called Bitcoin Capital. It was a company that was set up to invest in mining and crypto companies. Some of the investments we made was Kraken in the early round, where co-investment with Pantera Capital is, and we made an investment in Bitstamp, which was a European exchange, and we put 1/3 of the money in mining. The interesting thing is that at this point we were just after the Mt. Gox collapse, and we started mining around about when Bitcoin hit a low of $250. And we have some of our investors in the room today that were actually some of those original investors. And we were paying out thousands of Bitcoin, and some of them have just kept it, not done anything with it, just left it on the platform. And we started to generate a really great community of wealthy crypto investors. Then in 2015, we did the same with Ethereum. We decided everyone was creating things called cloud mining, and we decided to create a security and sell it in compliance with securities laws, where people could invest in a security and they received daily dividends in Ether, just like we did with Bitcoin. And then that was about a low of $1, and people held it all the way up, and that made a lot more wealthy investors through our platform. That really was the foundation of the community. I personally relocated to Hong Kong at this time, myself and Bliss Dixon, and we then registered with the Cayman Island Monetary Authority so we could do this on a global scale. Then a really interesting thing happened, a very unfortunate situation for Bitfinex, but they got hacked for 119,000 Bitcoin. And we got on the phone to the Bitfinex team and said, we don't want to have a Mt. Gox scenario that holds our industry back for another 5 years. So we constructed with them what I consider to be the world's first security token. It wasn't called a security token, but it was a promise to repay the customers that they borrowed the money to recapitalize themselves, a debt token. And we constructed a mechanism for people to convert their debt token into equity in the company. They were approximately down and bankrupt to about $72 million. After $55 million was converted into equity, they actually fully recovered, paid off the rest, and then we went into the 2017 bull market, and they paid out all of their profits throughout the bull market to our investors through the platform. So we had a lot of wealth that was generated through crypto exchanges, through Bitcoin securities, through Ethereum securities, and then the hack recovery. But then in 2017, something really interesting happened. We got disrupted. We were talking about Civic earlier. One of our clients, Civic, contacted us and said, Simon, we can't do the equity raise anymore, we're selling tokens. And then the phone rung again, can't do equity raise, we're selling tokens. And then it happened again and again and again, and suddenly we had no more customers. All of our investors stopped investing through our platform. They said, why would I buy equity? I could get 10 to 100x and sell in the next couple of days. So we created a process whereby our investors could invest in equity, in tokens rather, in compliance with securities laws. And none of the tokens that issued through our platform, with the exception of one, got in any regulatory challenge. The one that did is an ongoing case with Telegram that you're probably familiar with at the moment. But it was a pretty of an anomaly. So we had to develop that process, and despite the disruption, it was still our most profitable year, and we brought more opportunities through 2017. In 2018, we built a US broker-dealer so we could expand to the US, and we ended up selling that to Coinbase. That's so that we can help the industry grow into the security token space, and we look forward to seeing where that goes next. We also launched a secondary market whereby we allowed, because we were putting all of our equity deals into a special structure, we could make a market in those companies, and we could have some real-time pricing. The message was loud and clear. Our investors wanted liquidity, and so we created a way whereby you could buy and sell special companies that own shares in the largest companies in crypto. So there's markets for Bitfinex, SPV, Ripple Labs, Circle, Kraken, and many other household brands, and that's live today. In 2019, we went a bit of a merger and acquisition spree, so we decided that we wanted to look at the security token market. We invested in a US broker-dealer that was set up in order to allow for our model to compliantly onboard investors in the US. We also did the same for a UK institution, and we set about building a model whereby we could have a global securities business that was registered with the Cayman Islands Monetary Authority, but investors would onboard in compliance with their local regulations. We had to build this. After about 10 years, we built custom onboarding processes for about 40 different securities laws around the world, just in order to allow for the funding of these companies. We also acquired a company called altcoin.io, which was the first company to do an on-chain atomic swap between Bitcoin and Ethereum. They open sourced the wallet, and they built a decentralized exchange. In 2019, though, there was a case with the SEC where a company called EtherDelta was essentially being done for running a decentralized exchange. So they came to us and said, could we use your licenses and can we integrate this into security tokens? So that's our next move. We're looking at turning some of this decentralized technology using our more centralized onboarding to usher in the next wave of investments in security tokens, doing what we've already been doing for the last decade, but this time with fully utilizing technology for the process. So as I said, our big winners, and we have many of our investors in the room today, were equity and crypto exchanges, securities that paid out Bitcoin, securities that paid out Ethereum. What we've learned really from that, and our next move, as we move over to the panel, is that if you can build securities that are for the crypto market, then this is where we're focusing our market. We believe that institutions can join, but we've always built for the crypto industry. Before the crypto industry, building securities by the crypto industry for the security industry, for the crypto industry. So setting the scene for what we're doing for the next 10 years, we think this intersection between decentralized finance, the amount of innovation that was built on top of Ethereum over the bear market is absolutely stunning and incredible. Centralized finance, we built centralized onboarding processes for the last 10 years. And if you combine those with securities, we think that you can have some ultra interesting investment products. We're focused on the high risk, high return thing. We're not interested in turning a real estate investment trust that pays 8% per annum and trying to get someone to give up their Bitcoin to a middleman in order to buy real estate through a token because they don't give a damn. So we're more interested in what high risk, high return opportunities can we build, because that's what our type of investors are looking for. So it's this intersection. Couple more slides, then we'll move over to the panel. One thing we decided to do was, because we built all these onboarding process to allow for global compliance with securities laws, we decided to take all of our broker registrations, our compliance, our certification, all of these different services that we built just in order to do our business, and put them in an application so that other people could actually use it to offer securities, and we can integrate it into some of our other products that are coming through. So now you can register globally with a broker-dealer in compliance with local securities laws, and you can go do the compliance with local securities, and we can use that in order to sell securities globally as we have. So we've got that for Bank to the Future. That's our centralized platform, and now we're turning the acquisition into BFX, the decentralized platform. We're playing a bit of an interesting scenario, so this is what we're introducing for the next 10 years. BFX, Bank to the Future X, is our next platform. It's centralized onboarding in compliance with local securities laws, but decentralized trading, so that the activity of trading is peer-to-peer without having to get local markets and recreate the entire NASDAQ. We think this is the only way to do that, and partnering with companies that are looking to use local regulations and plug in the liquidity together. This is the type of products that we're looking to bring to market. So the next plan for us, 2020 and beyond, we're launching our own security token built with everything we've learned over the last 10 years that we think makes great security tokens. High risk, high return, crypto income, revenue share, but also backed by equity. You know, Blockchain Capital created one of the first securities with a token, and essentially it's maintained its value because it's backed by net asset value. Some of the other less successful security tokens, they've given out revenue shares, but they've crashed in price because it's based upon profit of an unprofitable business, and people get spooked out and sell. So we're looking at taking some of these trends and what we've learned over the years, combining them into the next generation of security tokens. We prove the market, we want to show that it can be done and create an interesting security token. And then we're going to trade it on BFX, our decentralized yet compliant security token exchange. And then we'll call all of our customers one by one and see if we can do the same for them, so that we can really usher in the next wave of security tokens. So those are some of the things that we're focused on next. And we're on a bit of a roadshow sharing what we're up to. Next stop after San Fran is Cancun at Satoshi Roundtable, then at Asia Tour as well. So I think that brings us nicely into our panel. Mark, how do you want to do this? Are you going to host?
Yes, I will ask all the questions, and I will do it quickly and mercilessly. So we hold on to the clock and we get some interesting conversation. So if our panelists could please take a seat, that would be great. Let's give a hand for Simon and that amazing OG story. I'm still kind of like, oh my gosh, did this stuff really happen? Yes, this is crypto and this stuff really happened. So that's kind of crazy. So we have an amazing panel here. And we have, I'm just going to let Joshua start and we'll just go down the panel and everyone introduce themselves and we'll jump right into it.
Hi everyone, Joshua Rivera. Can you hear me? Great. Joshua Rivera, I'm the General Counsel at Blockchain Capital. I've been there for about 2 years. And we are investors in the space. We are a venture capital firm. We invest in it's called multi-stage investing, so seed rounds, 100 to 500K checks, all the way up to your DEFs, where we'd be smaller investors in those rounds with $10 to $15 million checks. Notable investments that we've done recently are Bison Trails in Anchorage, those were last year, as well as analytics investment company called TRM, so we did that alongside PayPal. And yeah, we've got about 300 million assets under management. As Simon said before, we were kind of one of the pioneers of the security token. First to tokenize an investment fund, this is our third fund. We're really excited about the future of security tokens and other areas in the space. So yeah, be excited to talk about it.
Thanks. Hi everyone, Brian Foster. I'm from Coinbase. I work on the institutional team primarily, so we help asset managers, hedge funds, VCs, family offices, endowments, other allocators get into the crypto space, and we do that through helping them with custody and trading. So Coinbase was founded in 2012. We currently serve about 30 million clients in total. Our institutional business is growing quickly. We custody about 7 to 8 billion in assets just on behalf of institutions. In addition to helping grow our institutional business at Coinbase, I sit on the Coinbase Ventures Investment Committee. So we also do seed stage investing in crypto. We'll back companies, protocols. We have about 60 different entities in our portfolio today. My background before Coinbase is in venture capital and initially foreign exchange trading software.
Hello, everybody. How are you doing?
Woo. Yeah.
Woo. I'm COLEY. I'm here from Binance US. We run an American exchange here in San Francisco, and we have a real devout faith in the freedom of choice. So we provide 28 tokens and hopefully more with a range of ways for dollar on-ramps into the digital asset era. So we really are hoping to bring in more people, get them comfortable with the understanding of digital assets, what's beyond just trading, and where we can listen to what the U.S. really needs from a platform and cater to it.
Thanks. Hi, I'm Paul VERADITTAKIT, and I'm with Pantera Capital. I've been with Pantera now for about 6 years, and Pantera has really evolved quite a bit, since 2013. We're one of the first funds, or maybe the first institutional hedge fund for Bitcoin, allowing institutional investors and high net worth individuals to buy Bitcoin around $40 a Bitcoin. And then, since then we've launched a VC side. Our venture capital side is about $400 million. We also have an ICO fund that invests into pre-sales in token projects, and also a later stage token fund that invests into token projects that are already on exchanges. All in all, we have probably about $600 million of assets under management. Our team is fairly large, about 25 people. The main investment partners are myself, Joey Krug, who's one of the founders of Augur, and Dan Moorhead, who came from Tiger Management as CFO and head of global macro trading. As you can see, we sort of, invest early, late stage, token, equity, fairly agnostic, trying to focus on seed and Series A, and we've created a great platform to really help our companies scale. Outside of that, more recent investments would probably include still doing a lot of exchanges, so ARSX, backed, and some infrastructure plays like Alchemy, which is node infrastructure, and I don't know, there's a bunch of other ones.
Okay, and I think we know this guy on the end. Terrific. Can you guys hear me okay? Okay, great. Terrific. Well, so with such an amazing panel here, what we really want to pick your brain on is what is the outlook for 2020? Quick, one sentence, what you see ahead in 2020.
So for us, we're really focused on institutional adoption in 2020. We think that that's really going to be the catalyst for broader adoption, is getting traditional institutions comfortable with a natively digital asset class. It takes a lot of work, a lot of infrastructure to be built, and that's why we've kind of been focused on that aspect of the industry as of late.
Great, 100% agree. Spending a lot of time during the day working on that myself. I'll try to come up with something new here. I think two areas I'm really excited about that we're seeing a lot of progress in 2020 are the distribution of stablecoins. So for use cases beyond sort of market making and trading on the institutional side, but more utility for retail. This is a really interesting theme. And another is the professionalization of DeFi. So super early innings for DeFi still, about I think 1 billion total locked in smart contracts today. So we're like a small regional bank roughly in terms of our size. But a lot of interesting work happening on top of DeFi, so excited to see that continue to advance.
We're really focused on practicality, so making sure that there's a platform that's useful, making sure that it's reaching an audience that's broader than what we currently have, and building out products that are beyond what we have existing.
So I think there's definitely some similarity. Institutional infrastructure, we've done a lot of investments in DeFi, obviously on-ramps, and I think outside of that, developer tools. You know, we think that there's going to be a need, especially as scalability starts going, more and more scalability solutions start going out to market, and there needs to be companies that build tools for developers to more easily develop on top of different blockchain protocols and you know, help facilitate interoperability. So that's another area that we're looking at.
Yeah, crypto securities for, I'll try that one. Yeah, crypto securities for crypto investors. And a belief that we're currently still operating in the world's largest regulated Ponzi scheme called fiat money. And people are going to actually need some tools when the next systemic risk event happens. So making sure lots and lots of people are able to onboard and recognize that there is an alternative outside traditional, because we haven't fixed anything since we started in 2008. So.
Okay, so since we're in a law firm, let's get this out of the way quickly. Let's talk about regulatory issues. Obviously, Catherine, the reason you all are here in Binance US is because the regulatory framework looks very different here than around the world. Security tokens were all the rage a year and a half ago, 2 years ago. I was running business development for Swarm Fund. There was a big platform for security tokens, and then everything kind of went quiet because there's no real liquidity. There's no market yet for security tokens here. But what do you all think, number one, about security tokens, where that's at and where that's going? And then what do you think about the regulatory framework, and where is the regulatory framework most conducive to digital assets?
I'll give it a go then. Okay, so I believe in two models. One, which is kind of what Coinbase did. They took their time with regulations and they put together a very, in a grey area, a very bespoke regulatory model unique to several jurisdiction by jurisdiction. I also believe in what Binance did, where they take a bit of a regulatory arbitrage, a legal model, but operating on a global scale so that it can move faster, build liquidity, and then start fixing some of the local regulatory challenges as you move on the ground in each jurisdiction. I think the liquidity in the security token space is going to come from that regulatory arbitrage of doing things in a global model compliant, and then later, once liquidity is actually built up. So we invested in several ATSs and MTFs that were using really, really expensive infrastructure and essentially trying to recreate New York Stock Exchange and London Stock Exchange in Europe. but they all went bust one by one, or they're all in a real deadlock with the regulators. In the meantime, I think someone's, hopefully we can come along, or someone else can come along and really play those regulatory arbitrage, create liquidity and security tokens. And I think the main issues is everyone was promising liquidity, then there was no liquidity. So they need to actually create products that make sense without liquidity, and then they need to get the product matched to the right investor. If you pitch a crypto investor, a real estate investment trust, they don't want to give up their Bitcoin. If you pitch a institutional investor a product, then it's tokenized. They'll just say, if I like it, please take out the token, and then I'll just invest that way. So it's about getting the match right with the technology versus the investor profile.
So Paul, as an example, well, Paul, you and Joshua both deal with a lot of traditional investors, right? You have Bitcoin fund, you have a venture fund. I'm sure you have a lot of LPs out there who you're not the only place they're putting money. How do traditional investors think about the opportunities around digital assets and security tokens right now? Do they understand that yet? Are they kind of nervous, or what's the state of those investors?
Yeah, I'll sort of touch upon a little bit on the security token and just kind of move into exactly what you mentioned on what are investors interested in as limited partners. On the security token side, we invested into Harbor, and I think I agree with everything that Simon mentioned in terms of you have to fit into what the jurisdiction says about security tokens, and it seems like Asia is probably a good place to start. Japan and Singapore, I think, are being a bit more innovative and coming up with some regulations. But it really just starts off with supply. I mean, if you can come up with really intriguing supply and reduce the friction to get onboarded onto these platforms, maybe doing it in a more centralized way to start with, but sort of having blockchain and smart contracts in the background, I think that's a way to sort of go about it in a certain jurisdiction. In terms of investors, we are set up slightly different than some of the other funds out there. We have a fund for every strategy that we do. I think there's some funds that take an approach where, we're going to just do, a pure illiquid strategy and we may combine a few different strategies, or we're going to do a pure liquid strategy and combine a few different strategies. Every strategy for us is very different, and it's done that way because the market sort of just evolved that way, where, the early adopters in our space just have preferences. But I think things are shifting a bit more. We just got a pretty large endowment come into our fund, and I think some of these institutional folks really just want to remove the complexity of having to make decisions. And so if you can just say, hey, we're going to go with blockchain capital, we're going to go with Pantera, and instead of us figuring out that we want 33% Bitcoin, 33% venture, and 33% liquid tokens, just handle it for us. We want a special, separately managed, asset fund, and we want you guys to just figure it out. We don't actually want the liquidity. So I think that's kind of where things are shifted now. But beforehand it was like, well, I can buy Bitcoin off of Coinbase and Binance, but man, I can't get into the next hot custody round. Give me access there.
Yeah, I agree with a lot of that. I think that what we're seeing is kind of so we have 3 traditional venture capital funds, and then we have a tokenized fund. The LPs in each of those funds is very different. So the tokenized fund, those are retail LPs. They're all accredited investors, but they're not larger institutions. Whereas for our latest fund, the 4th venture capital fund, which was kind of one of the first institutional venture capital funds raised, that fund has a lot of high net worth individuals, fund of funds, family offices, etc. And those, like Paul was saying, they very much do not want to have any kind of say into how the decisions are made. They're just like, I'll get in the car, you drive, take us where we want to go, and they just want to make sure that they're getting exposure to the best assets in the industry, whether those assets are tokenized assets, whether it's Bitcoin, whether it's the equity of the best companies in the space that are going to grow because they're building things that people want. On the security token side, institutions are still very uncomfortable managing digital assets. And you think about what large institutions are used to dealing with, it's like paper stock certificates, and those don't go. You put them in a vault, they don't go anywhere. You don't have to worry about it. If you lose the combination to the vault, there is some tool out there that can break the vault open if you need to. But custody for traditional assets, whether it's dollars or bonds or stock certificates, is really simple, relatively speaking, and we've been doing it for a long time. So institutions don't have to, they have set protocols to deal with that type of custody. They don't have to think about it. When you talk about a natively digital asset, it's really difficult for them to wrap their heads around the best way to custody an asset like that. And so that becomes a gating item for them. They don't want to hold that because there's a lot of risk associated with it. So what we're seeing is we're seeing them want to have someone else be able to do all of the technical work, investing, but also all the work around managing the digital asset because they don't have the expertise to do that. So I think as they become more comfortable with those concepts, hopefully we get more demand on the buy side. So what are you talking about, like supply? You need products that people actually want to buy. Lots of companies want to sell a security token because it's kind of sexy, it's like the new thing, but few people are like, oh, I want to hold a security token and buy it from someone else. And so some of that is kind of the product market fit that Simon's over there working on, which is really interesting things. Some of it, so one of our portfolio companies, Securitize, is doing some interesting things with institutions where they're tokenizing assets not for retail, but for other institutions to kind of trade among themselves, talking about things like commercial paper, other interesting debt products, some derivative things, where there are sophisticated institutions that will want to be involved in that.
Yeah, that's pretty amazing. So, Catherine, we were speaking beforehand about your focus on creating products for the U.S. market and to make it crypto easier to use beyond the initial early adopters. It'd be great to hear a little bit about your thoughts and what sort of things you're working on and how that kind of dovetails into what Joshua was talking about. Maybe the consumer adoption will help drive the institutional adoption. Would love to hear.
Yeah, I think there's a really great aspect of crypto where we're predicting what people really want and then building it. And so our view on that is a little different, where we are very keenly listening to what the market is desiring and then building that for them. So rather than predicting and expecting their problems, we're asking them what their problems are, providing the solutions for those in real time. So we are in touch with our customers in the sense of constantly asking them, what would you prefer, staking over additional listings, and listening to kind of exactly what it is that would drive their understanding, whether it's a lack of education they have around certain things, whether it's more compelling use cases around crypto, or just easier processes. Our KYC we've streamlined to be an easy process, and I still get a complaint about it, and I'm going to retweak it tonight and think about how we can make it even better. So there's something in the real-time aspect of us building this for how people are operating now, rather than predicting how they're going to be doing it in 10 years' time.
Okay, so one question. We have Lisa here from Hub, Join Hub, which is the co-founder of LinkedIn's company, Eric Lee, and it's a really interesting community. And we put the event out on the community, and a couple questions came in, and one of which was like, what happens to all these ICO tokens that we bought in 2017? Binance globally has a lot of those things listed. Are they, like, what % of them are roadkill? Are they all going away? Like, what's going on with all these ICOs?
Investment advice?
Yeah, I'm not going to give you investment advice.
No, not investment, but just structurally, right? There are a
I
lot of
steer
these
clear.
things that, there's a concept in the regulated public markets of delisted things, and they go to pink sheets, and if they don't meet their regulatory requirements, they're gone, they're off the exchanges. What does that offboarding look like? Everyone knows what it was like to onboard. What's the cleanup process, I guess, looking like?
I mean, we launched September 24th in 2019, so we really haven't offboarded anything yet. We've just been listing them based on our digital asset risk assessment framework, which reviews the process of full structure investigation on that token and their community that they raise inside of the United States. And so that it's a multi-point process for us to be sure that this has a viable community inside of the United States with adequate liquidity and a healthy market and use case ahead of it. So those are really our processes for going through the listing. We've announced kind of our 30 coins that we were exploring at first. We've listed 28 of those. We've then listed another 20 coins we're looking at, and we'll continue on that process. So.
And Brian, Coinbase has been well regarded as being almost too conservative of listing new assets. Recently, more assets have come onto the platform. What's your perspective on that? And then the technical question is, what happens to the shitcoin? If it happened to make it onto your platform, what do you do about it?
Yeah, I think I'll steer clear of shitcoins. But what I can say is that Coinbase is dedicated being both the easiest to use and the most trusted. And we think these are really the fundamental value props that will help drive adoption of crypto broadly. And the trusted piece is super important there. So we would rather be deliberate and make sure that everyone we're adding to our platform is doing things the right way than go very quickly and risk degrading the trust part of that equation. I think we'll continue to operate that way going forward, but I can say that we're certainly well-resourced to add more of these assets, and we want to be able to do that. We're just going to be thoughtful and controlled about the way we do it.
So one quick follow-on question to that, which is about custody, right? Coinbase, I think, has done the best job of making a kind of complete experience most akin to a traditional trading platform where most consumers don't think about the private keys. But obviously there's a risk of private keys. There have been those stories in the news of SIM swapping where people have had their accounts drained. What is a consumer actually, for you and Catherine, does a consumer want to be self-custodying keys? Do they understand that? Do they want you all to manage that for them? Is there going to be some sort of insurance that if there's a hack that consumers are protected?
I don't generalize that much. We focus on our consumers as multiple parts. So you have to realize there's some that have no idea that they want to be handling their private keys, others that desperately need access to them, others that are diehard, anarchists for that reason, not even wanting to be on top of an exchange. So we really don't categorize them as one consumer, and I think that's something we have to be acutely aware of when we're talking about things, especially America's crypto community, is that we cannot lump them into some of parts. So we have to really focus and build out things specifically that would be attractive to each of those groups.
Yeah, I was gonna touch the shit coins. Not being on an exchange, I have a little bit more leeway. Blockchain Capital is invested in its fair share of shit coins, which is just like a fact of life. But it's no offense to anyone, but the fact of the matter is, look, most of our investments are going to come to nothing, right? That doesn't say anything about the entrepreneurs that we invest in or their ideas or the platforms, except that they just didn't work for one reason or another. You hope that 25% of your portfolio companies are successful, and that like 4 or 5 of those are like mega unicorns. But that's like a great investing record for a VC. Pantera excluded, they're much better, of course. But the idea of a shitcoin, I mean, we like to shit on shitcoins, but I think back to the .com bubble in the late 90s, people felt like, okay, if you have a .com behind your name, you're going to be successful and you're going to be profitable, which was just a shit idea, right? But that was actually really healthy for the market to understand the value of those assets, like what a .com is and what it means. It had to go through that kind of revaluation so that people could understand that that was not the indicator of success or of kind of being a profitable company. I think it's the same with natively digital assets, right? And so what's going to happen to these altcoins that don't perform in the same way? Well, people are just not going to use them, and then they're going to go away. I don't know what that means technically for their listing prospects on our esteemed exchanges over here. But I do know that it's just part of kind of regular market cycles. Do I wish there were less? Yes. But I'm confident that what's happening with them is that the market is understanding how to value the teams and the ideas that are going through this iterative
So,
process.
Joshua and Paul, what's your favorite terrible investment? What's your pets.com that you look back on and you're like, I can't believe we invested in it, but we did, and let me just...
Really? Come on.
No, I talk about that.
Yeah, I think, I'm not going to name any projects.
I'm not
But, I'd say lessons learned, which
Yes, that's
I
important.
could pivot into that. With the ICO market in 2017, I mean, you could have just thrown money somewhere and it would have just gotten 5 or 10x. I mean, it was just insane, right? And so, there's a lot of liquidity then too. And Coinbase and Binance, I mean, they're past the liquidity, and you guys should strive to get on those platforms. But there is a process and a regulated process now to get listed on U.S. exchanges for sure, and then even a process to get on international exchanges. And so, with liquidity not being the way that it was beforehand, but it was really liquid back then, people were just throwing money out there and without any diligence whatsoever. And there was just so much capital that even top firms like Blockchain Capital, us, and Andreessen, I mean, we're making decisions on companies within days. I mean, sometimes within hours. And
not good.
looking backwards, I mean, I would say that sometimes you just gotta stick with your theme, stick with your process. Do reference checks. I mean, do the normal things that you normally would have to do to get comfortable with investment. And we made some mistakes back then by going too quickly. So now I think as everything sort of shifted over to the equity side and there's a lot more protective provisions, I think there's a lot more leverage that investors have. We can kind of do what we normally do, get the terms that we normally get, and really just set up the relationship for success so that both entrepreneurs can really decide whether an investor makes sense for their cap table, whether this is the marriage that they want. Vice versa, we can decide if this is the right fit for us in terms of what they're trying to solve, the right team, etc.
And are utility tokens still a thing for you all to invest in, or is the market shifted that you just want equity and the token side of it is not as interesting anymore?
That's a great question. Utility tokens, there's kind of different ways to define it, but from a regulatory perspective here in the United States, utility token is kind of anathema because the SEC doesn't like that term, so that's fine. But I think when we talk about utility tokens, it's important to highlight and underline and bold the utility. And so just like whatever your favorite token is, like just think about it, like what is its utility? What does it do for you? I think we still believe that the most useful token is Bitcoin because it is the most excellent digital store of value that we have right now. And so that utility tokens, sure, but I think what we're really looking for is what are the use cases for these digital assets? How do they actually facilitate commerce, finance, whether it's a stable coin or whether it's some other kind of decentralized finance asset. There are many arenas where there could be utility, or maybe it's gaming, right, a non-fungible token. But we need to see what that utility is, and so that's kind of where we have held up to let teams develop, let their ideas grow, and see it gain traction in the real world.
Yeah, I think there's a couple of interesting observations. Firstly, touching into the Bitcoin thing, we're in a Bitcoin-led market, so the crash of the ICO was from the crash of Bitcoin, the correction of Bitcoin. The growth of Bitcoin was from the growth of the ICO, and so what's going to be interesting in the next wave is when Bitcoin starts to go up as it is today, people are going to still, and it seems like there's such a correlation between the tokens that are actually doing stuff and survive the bear market and Bitcoin, but yet our token tends to go up higher than Bitcoin when it's pumping and crashes harder than Bitcoin when it's crashing. But eventually, when that goes into some kind of more sustained bull market, crypto investors are crypto investors. If something's going to pump harder than Bitcoin, they're going to start buying those tokens again. And I think we could just go into the same cycle again. And I think the other interesting thing that came from the token side is some of the trends that we saw and what the regulatory effects. So when the token market first started, you know, it was a bunch of us Bitcoiners that wanted to fund this thing called smart contracts, and Ethereum seemed like a really good idea so that we could have these, you know, tokenized assets and all these things that we were talking about at the time. And it really was. It wasn't an investment. It was just chucking some Bitcoin in so that this platform could be built. And it almost went bankrupt in the process of trying to build it. But it was pure crowdfunding at the time. It was anybody could chuck over some Bitcoin, no KYC, no regulations, nothing. And it was showing that thousands of people can contribute to a project. And it was a really interesting time in history. Then suddenly the regulations come along and all the VCs were negotiating huge discounts. And then the venture funds suddenly felt like a hedge fund because they were like, well, we were originally investing in these things. Now they're liquid. How quickly can we get out? And dumping onto retail. So the regulations actually created a complete distortion of what felt like a pretty pure market in the beginning. And you know, that was when all the shenanigans happened. And then we couldn't suddenly go back, you know, full circle because these things are crashing. And I think the interesting thing was that came out of that was, you know, for the first time, there was a bunch of young people that were really never going to be investing in stocks, bonds, commodities, any of that stuff. They come from the generation that was not interested in, they were the generation that was never going to get on the real estate market. And for something happened in 2017 when it captured their imagination. And yes, scams aside, all sorts of shenanigans. It was really awful, some of the things, you know. We had someone do an ICO for our company and it wasn't me. I was an advisor on 10 companies in China that I knew nothing about. You know, the shenanigans were horrific. But it captured the imagination, and suddenly this next generation that was never going to get into investing was suddenly thinking about savings and investing and what's going to make the next bit of money. And that's something they were going to skip. They were never going to get, you know, they were in a debt cycle from their university loans. And so, you know, it's really interesting that there are two sides to this whole story. You know, regulations certainly offer some consumer protections, but it also cuts out a lot of people from building their financial future. And that challenge is always going to be a challenge that we've wrestled with over the last decade of, you know, it's an interesting thing to see the effects that regulations have.
Yeah, that's something we really focus on as well, is that idea that will crypto literacy reach more people than financial literacy was able to reach? And at the point right now, they have to go hand in hand. You have to understand how to manage your own capital in order to understand how to manage your crypto capital. That's something that we're really caring about and focused on making sure that you have a full education around what it is, because it does unlock so many doors. It does give you a different aspect. The idea of investing beyond your 9-to-5 job is something that you normally don't have access to. You have a broker and the broker closes at 4:30. So you really need to be able to understand what it is that is opening, what crypto is opening from a financial freedom perspective. That's something that we're really thinking can do a lot more in a magnitude of the world that is far more global, far more social, far more mobile.
And I saw a great comment a little while ago where someone said, you know, an investor should not be judged by their bank account. Like the whole thing, like, are you a qualified investor? You know, if you're not worth $1 million, you shouldn't be into these sorts of things. And kind of like what you all are saying, especially you, Simon, this has really been a democratic movement, you know, with a small d, of everyone, you know, wanting to literally, you know, without any friction, fund and build businesses. So I think that's a great thing for the market, and I kind of miss those days, even though with all the problems there were. It'll be interesting to see if that comes back. Brian, you were going to say something earlier about...
Yeah, I think just around the point of custody, you were asking about sort of development of custodial products and services and how that might be impacting adoption. I just think we've seen an incredible headway in the last 2 years. And you know, Coinbase offers obviously a sort of non-custodial wallet. So if you want to be managing your own private keys, you can of course do that. But the custodial services have become so much more advanced, and we're seeing that with Coinbase Custody for institutional users, you know, going from 0 to more than 7 billion in a year and a half, where the security, the controls that are in place, and then enabling the participatory features that come with some of these protocols really make the value prop for using service providers for custodies super strong. And so I think we're just seeing a rate of innovation and investment in custody as a service right now that makes using service providers a lot more compelling for most users of the ecosystem than self-custody.
Yeah. And Catherine, earlier we were speaking about proof of stake and staking and all these different products. I'm really excited about the whole staking as a service sector. I'd love your all's input on staking, proof of stake, what you're seeing, how that gets productized for investors.
Yeah, I think it's one of the elements where people that saw crypto as just a speculative asset now are being able to advance beyond that kind of caricature of it. So seeing that staking allows you to be a participant in the governance of a network, really being able to hold the value of that token for sake of keeping its governance alive, and then gain rewards for it. Something that gives people a little bit more of a tangible understanding of why they would be involved in a certain network. So for the sake of ours, Algo and Atom are the two that we're going to be launching first with. Those are two great communities that you're able to understand more, and by participating in it, you'll gain the rewards of being an active participant in those network health.
Yeah, no, I totally agree. I mean, I think this is where most of the protocols are shifting. Ethereum is shifting that way. I think it really just kind of goes with the ethos of just like, having people really just, help maintain the network, help secure the network. And, so I think on a macro level, it just makes a ton of sense. I think in terms of the operational level, I mean, it's also great that you can go out there and you can run your own node and you can stake yourself, or there's services out there, whether it's almost like an API that you can basically hook into and partner with another company to do your staking for one or many of your cryptocurrencies. And then, you can also just even, work with the company to host your own node, almost like an on-prem sort of structure. And, that's probably maybe a bit more useful for an enterprise or an institutional customer because of some of the things that they have to sort of deal with. But, you have the option. You have the option of doing it yourself. You have the option of working with others. And, it's a great way to really just help participate in the community.
Yeah, I think proof of stake is really the birth of how we actually arrive at a full decentralized banking service with all of these different products that can be built on top of that type of, you've got Bitcoin as sound money, this solid rock, volatile solid rock, but this solid rock that makes the backbone of our industry. Then you have Ethereum that's allowing for all these incredibly interesting solutions, imagining up any financial product that anyone can imagine. And then the fact that these things are all moving to proof of stake is kind of reiterating the value of having this solid proof of work chain, Bitcoin. And then, for years people have been talking about the proof of stake thing. Now finally we're starting to see, and it really is one of the most exciting times to be alive in financial history at the moment. Like, it really is a fascinating space, and the next bull market, the amount of stuff that's been built over the last 2 years is just, to see that come into effect, it's the disruption of every single financial product one step at a time, and it's really exciting to see.
So I'm just going to ask two quick questions because we want to keep the clock rolling now at 7:18. When we're done, we're going to go either through this door or through the back at that door and walk straight over to the food and wine area, which is going to be a really great time. And all our lovely panelists will be there for you. Unfortunately, we don't have time to take questions now, but please feel free to stay. And remember, at 8:25, we're going to start yelling at you because we need to get out of here. And again, if you, one quick favor we would ask, there are these little half sheets on your chairs. It would be very helpful for me as the organizer putting this thing together, for Nixon Peabody, for our panelists. We're going to share all the feedback. If you could give us feedback, and if you have any questions or comments, please fill it out here, and we will follow up. So just grab one of these and fill it in and leave it at the front desk or with one of my colleagues who are floating around. So quickly, there are, I don't know how many Layer 1 protocols coming to market in the next few months. Is there room for all of these? Is there anything out there that you're like, wow, we're really excited about this one or that one?
Yeah, would certainly say, there's a few high-profile launches, obviously, well documented, that are coming up the next few months. It feels to me like this may be the sort of tail end of the large momentum in new protocol launches, as we're starting to see things really develop around some of the incumbent protocols in terms of developer activity and actual movement and usage of crypto. I think some of the network effects just start to get really locked in, and the sort of case for creating new protocols becomes more and more difficult. So that's certainly a theme that we're seeing. At the same time, some of these protocols are super interesting and are bringing new technologies to the table. The thing that I'm interested in is how can they really get distribution to developers quickly in order to compete. And the industry is still small enough that there certainly seems like there's a shot for that to happen, but that's the challenge. Can you get developers really quickly, and what are you doing to get there?
Yeah, I think the idea that we're gonna have like 8 or 9 or 10 or 15 layer 1 protocols that all do different things, and we're all gonna interact with them on a regular basis is highly cyberpunk. Very unlikely to happen, in my opinion. Like, I just don't see a world where I've got 15 wallets for, or maybe one wallet, but 15 different assets that do different things in my daily life. So it becomes really challenging because there are so many layer 1 protocols coming online, and you want to, as an investor, you want to think critically about where value might accrue within that kind of layer 1 protocol space. We really try to take a horizontal exposure approach where we invest in companies that can provide us, if 1 or 2 or 3 layer 1 protocols are extremely successful and they kill Ethereum, we still do well, but we're not putting kind of all our eggs in like 2 or 3 baskets. But hopefully what we will see is we'll see some really great innovation in all of this layer 1 protocol. I mean, if you think about your search engine, right? There were 15, 20 at one point, Ask Jeeves, Yahoo, Lycos, and one kind of came out, and I think that's probably what we're going to see again. But hard to know why, those few will be the ones.
Yeah, I mean, it comes down to, you can throw out the technology. I mean, it has to meet a certain bar, I think. Developer experience, yeah, for sure. But it's really just getting people to build on top of you. And so some interesting ways that people are doing that right now. You have the, hey, let's set up a fund, let's set up an accelerator. Let's go out there and put teams together. And so let's do road shows where we're building communities all across the world, and we're partnering with different enterprise folks. I mean, whatever it takes, you just got to build that community. There's a few protocols out there that are doing it really, really well. I don't want to go out there and show, but basically, that's the big thing. I mean, I think technology is really just going to converge and just get a little bit more commoditized. But that's why Ethereum has, the biggest edge right now. It's their community.
Yeah, and on that note, I would say all of you are here building and participating in a community with leaders and participants, and that's what I like personally about the crypto world, is it's a very flat world, right? It's not in traditional finance where that person's sitting up on the 56th floor and you never see that person. You're interacting with the leaders right here. So I want to thank all of you for coming tonight. Let's give our panel a huge round of applause.